Welcome to Close of Business. I'm Alicia Barry. Donald Trump has promised his scattergun tariffs will see markets boom. But instead, Wall Street was flooded with red ink. His tariff war triggering US stock losses of $4.75 trillion. The pain was felt across the world. Investors here counting the losses in billions. Condemnation by world leaders has been swift, with stark warnings that making America great again could come at the cost of a recession. Rachel Clayton has the story.
Nervous traders watching trillions of dollars wiped from US shares.
The stock market suffering major losses on the heels of the president's tariffs.
The U.S. and indeed much of the world may be on a collision course with a recession.
It's those fears that sent investors running for the exits.
Frankly, the best likelihood of avoiding a recession is that there is going to be some deal making done and a lot of those tariffs are walked back.
The S&P 500 tumbled nearly 5% and the Nasdaq plunged almost 6%. The Magnificent Seven stocks were all down, with Amazon and Apple sold off the most. The US president wasn't fazed.
The markets are going to boom, the stock is going to boom, the country is going to boom.
But investors are being more realistic.
Immediate pain, short-term pain, long-term, nobody can really say.
I don't think it's going to take very long for it to settle out.
The losses reverberated across Asian markets and pushed the ASX 200 into correction territory. It fell 2.4%. The retirement savings of Australians were not immune.
People are going to be a little bit worried at the moment. I think it's very much about over the long term, you need the risk to ensure your super goes up and down. And most people only have about half their super in shares. So super funds are set up for these sorts of circumstances.
Small businesses, however, are not set up for such a large shift in global markets. And some fear the lack of tariffs in Australia will lead to a price war, with businesses overseas searching for new customers. Adam Corder's firm has put plans to enter the US market on ice, and he's worried cheap products will hit Australian shelves.
Being able to operate in our market and not have the same tariffs imposed may put us at a disadvantage if it came to pricing.
Figuring out how to stay competitive in uncertain times.
The Australian share market plunged into correction territory in the worst weekly sell-off since 2022. The ASX 200 dropped nearly 4% and the All Ords lost just a little more by Friday. Kyle Rodder, market analyst at capital.com, has been watching all the action. Kyle, the Australian market tumbled into correction territory on Friday. How much of that is due to Donald Trump's Liberation Day?
Well, if not the day itself, then certainly the anticipation of tariffs and what came from it was also a reason why we've pulled back from record highs, obviously only about 2 months ago now. I mean, there was the element that valuations were stretched. A lot of good news was priced into the market. So investors were kind of pricing in almost perfection, and, equities were kind of prone to shocks, it has to be said. But, really what's turned the tide over the last few weeks is, these fears that, Trump is going to go very, very hard on tariffs, that, this sort of protectionist American philosophy will continue to dominate his economic and foreign policy as well. And effectively, we're now seeing the markets pricing in the recession because of this, and that's why the stock market is down. So if not just Liberation Day, it's also just the build up to it that's really driven the markets from record highs.
And these are big numbers when we're looking at the falls. I mean, we're seeing 2% on Wall Street. We're seeing the likes of 4%, 3% in Asia, reminiscent of the GFC, really. How much worse do you think it can get?
So I think there's two things that's going on here. First is that the markets are pricing in a growth shock, and the tariffs that were announced this week were a little on the high side, so the markets are naturally discounting a bigger shock to global economic activity and earnings as a result. The second part, though, is the uncertainty here, and there's several layers to it, but there was hopes that maybe the Liberation Day announcement might have heralded at least some kind of beginning of the end to tariffs. We haven't seen that. We've already seen that, there's threats that there'll be sort of tit-for-tat dynamics emerging now between, the US and its trading partners, potentially raising tariffs even higher from here. And there is the sense that, the Trump administration isn't going to back off this policy, despite that, we're seeing signs of a potential recession in the United States and clearly a downturn in the market. So the thing is, while that uncertainty persists, while the Trump administration continues to push things the way that they are, there's really not that much of a prospect of things turning around in the immediate future. On the flip side, if they do start to sort of change tact, that could provide a little bit of support for the market. But for now, again, while that uncertainty prevails, I suspect risk will remain skewed to the downside.
Well, Kyle, if you started the year with cash versus Tesla shares, it's pretty clear who'd be doing better right now.
Yeah, certainly. And I mean, I guess if you look at just the behaviour of Warren Buffett at the start of the year, where, he went mostly to cash and sold down a lot of his portfolio. I mean, first of all, that was probably because of valuation. Things were getting expensive and, didn't want to put that money to work. And if anything, you want to take some sort of profits. But there's also that sense for a while now that there's been uncertainty and that a lot of investors want the sort of defensiveness and flexibility and liquidity that comes with cash rather than having exposure to risk assets, especially risk assets, say, like Tesla or like the Magnificent Seven stocks in the United States, which are going to be, prone to an economic slowdown, but we're also very, very expensive because of the run-up that we've seen in multiples over the last few years because of this euphoria around artificial intelligence. So increasingly, this sell-off is the market going to cash, liquidating those positions, trying to find safety, if not in cash, then bonds and other similar assets.
Well, when it comes to the RBA, it seems inflation worries are in the rear view now, with growth coming to the forefront. Rate cut expectations are rising.
Yeah, and in fact, we've got about 30 basis points priced into the curve for the May meeting now. We've got about 4 cuts baked in before the end of the year. That could be a level of overshooting as well. Sometimes you do get investors looking for safety in things like cash rate futures contracts, or at least to try and sort of play that kind of momentum on the slowdown recession theme. But clearly what is the case now is that, more than an inflation risk to Australia's economy, the tariffs present a growth risk. It does give the RBA a little bit more wiggle room to lower rates. The markets are pricing that in, and again, they're actually pricing in a better than 100% chance, if you will, that there will be a cut at that May meeting.
Kyle Rodder, thank you so much.
Thank you.
All of this chaos came after weeks of warning. Donald Trump unveiling his so-called Liberation Day on Thursday. The US president accused friends and foes alike of stealing American jobs and ransacking manufacturing. His answer was to unleash a minimum 10% tariffs on all countries, including Australia, with China copping an extra 34%. Here's Amelia Turzon.
The word of the day is tariff. This is probably worse than the worst case that was modeled. The Australian share market has tumbled in early trade.
From Australia to Asia, confirmation of US tariffs caused turbulence on global markets.
We've seen equities are down quite sharply.
It could drive the US into recession.
Liberation Day for Donald Trump marked a new golden age.
The day that we began to make America wealthy again.
And there was no tariff exemption for Australia.
Australia bans, and they're wonderful people and wonderful everything, but they ban American beef. We're doing the same thing right now, starting about midnight tonight, I would say.
The administration's tariffs have no basis in logic, and they go against the basis of our two nations partnership. This is not the act of a friend.
Australia has been hit with a 10% tariff, along with the UK, Singapore and Brazil. Our biggest trading partner, China, gets an extra 34%, bringing total tariffs to 54% since Donald Trump was elected. Products from Japan and South Korea have been slapped with more than 20%.
The concerning point is trying to account for the broader implication of worldwide tariffs and what that does to Australian demand.
I do think this is a bad day for our country, and it's not the treatment that Australians deserve, because we have a very trusted, long-standing and abiding relationship with the United States.
This Wagyu farmer was shocked to see the US president singling out Australian beef.
I was momentarily terrified about the implications for that, but it's since been clarified that it is just a 10%. Well, it is a 10% tariff.
Meat, including beef, is our top export to the States, worth $6 billion. Precious gems and metals are worth more than $3 billion, while we also export a lot of medical products to the US. Gold and plasma and vaccines are all exempt from these tariffs for now. On the flip side, major Australian fashion labels that sell garments into the States will have to raise their prices there.
From a small brand that's, just got a small loyal following in the US to larger brands like Zimmerman or Cotton On.
Shiraz.
This company that sells wine in the States is also preparing to raise prices.
No one wins by these tariffs being put in by Trump. And it's the end consumers that have to pay more for a beautiful beverage like Australian wine.
Many of the industries impacted by these tariffs, like meat and wine, are only recovering from sanctions from China. Economists say the biggest risk to Australia now is if Trump's tariffs hurt our biggest trading partner.
That in turn could reduce demand from the Chinese for Australian goods, Australian commodities, etc.
Yet economists say there are possible upsides for our economy too.
It's possible we might actually see some of those goods that would have gone to the US come to Australia instead, and that would actually provide more supply.
Inflation will be driven lower, and that could mean another cut to interest rates by the Reserve Bank in May.
Just an email that came through. Hi team, just my own little protest against American products.
A local whiskey company is already seeing the bright side as Australian drinkers boycott American bourbon.
People are discovering us and saying, you know what, my money doesn't need to go over to a multinational back in the States the way they're carrying on at the moment. Let's keep it in Australia. That was really cool to see people really having a crack and getting passionate about the underdog.
After today, many in Australian business might need a stiff drink.
Tim Harcourt is the industry professor and chief economist at the Institute for Public Policy and Governance at UTS and a former chief economist at Austrade. He joined me to discuss the cost of Donald Trump's new trade war. Tim Harcourt, welcome to Close of Business.
Good to be with you, Alicia.
Now, would you categorise this as Liberation Day or Disaster Day?
I think it's Devastation Day. I mean, basically because these high tariffs are like putting rocks in your own harbour for the United States. And ultimately the big loser will be the American worker, the American consumer, and eventually the American farmer as well.
And we'll get to how they lose in a second, but Donald Trump has made so much of these tariffs being reciprocal, but in fact they are a very simple formula, being the trade position the country had with the US versus the amount it exports to the US. What is this about?
Well, Donald Trump thinks that if you have a trade deficit with a country, you're losing, and if you have a trade surplus with a country, you're winning. So basically, he takes the trade balance divided by the exports to the US, and that's where you get your formula. And that's why you get countries like, say, Vietnam with very high tariffs and Australia with trade surplus, the 10% tariff. And then also, because he's gone right across the board, you end up having countries that only have penguins in them getting a tariff as well. So it's obviously a simple formula because it's not very well thought out because it's been caught up all these other countries that don't really trade at all.
And as you mentioned, American consumers and workers are going to take a hit. US companies that manufacture offshore are also hurting. I mean, we saw Nike, who manufactures in places like Vietnam, fall 15% in one session on the stock market. I mean, the average US tariff rate is going from 1.5% to 29%. It really is Americans that are going to be feeling the pain.
Well, they're going to be feeling the pain in their pocketbook and ultimately in wages and jobs. But I think what's going to occur is that some American companies are going to be thinking about going back to the US, but then there are some Australian companies like BlueScope that already produce, say, steel in the US. They'll concentrate on the domestic market and they'll probably be better off to some extent. Others are going to have such a big drop in their share price that even moving back, the harm will already have been done.
And what's the investment incentive if you're going to go back to the US? Because it's a 4-year term for a president. These tariffs could be repealed in the next term. Is there a long-term incentive for companies to start industry in the US just because of these tariffs?
Well, this is one problem with the President Trump's approach, is that not only have you had tariffs, but you've had a lot of tariff uncertainty because with Canada and Mexico, Colombia, Venezuela. He had them on, he had them off, then he doubled them, then he took them off. And that causes uncertainty. The last thing investors want is uncertainty. I mean, even Australia, when we had our tariff schedule in the Hawke-Keating years, we had it going down for 15 years. So companies, even though they didn't want tariffs to come down, they had some certainty in terms of investment. So it's really not just the economics of tariffs, it's the economics of tariff uncertainty.
Well, these tariffs are at a level we haven't seen in around 100 years. In fact, they take us back to the Smoot-Hawley tariffs of the 1930s. I mean, history tells us they didn't work then. Will they work now?
Well, they made the Great Depression worse. Those tariffs. I mean, there were obviously was the Wall Street crash and the bank collapses, the monetary policy sort of collapse. But when Congress decided to pass those tariffs, it actually made the world economy and the American economy much worse, including the 10% tariff increase we did in Australia that made the Great Depression even more severe here. So trade barriers basically causes the backlash from your trading partners and ultimately makes a recession into a depression.
Now, Donald Trump, of course, won the popular vote, if you like, but a Gallup poll shows that 81% of Americans think global trade is actually an opportunity, not a threat. Is he at risk of losing his base?
Well, it's amazing because really the tariffs are really going to hurt the steelworkers of Pennsylvania and the farmers of Wisconsin. They're going to be most affected by tariffs. Now, he's not going to run from re-election, we assume. But it'll be a real problem for his successor.
Tim Harcourt, thank you.
Thank you, Alicia.
If it wasn't enough that super balances have taken a hit from the stock market sell-off, it's been revealed Australian super funds have been the target of a coordinated cyber attack with losses of around $500,000. Australian Super says it's seen 600 attempted cyber attacks in the past month, and 4 members have together lost upwards of $500,000. Another fund, Rest, says no members' cash has been taken. The industry body ASFA says cyber attacks were also attempted on other funds recently. Funds are contacting affected members and helping any whose data is compromised. The corporate regulator has issued a damning report of the superannuation sector, revealing systemic governance failures into the handling of death benefit payments. As Nassim Kadem reports, ASIC is warning the sector is leaving some Australians worse off at an already vulnerable time of their lives.
Kathy Clark didn't think that when her brother Craig passed away, she would face more grief. But her brother's superannuation fund, Australian Super, took months to pay out Craig's death benefit.
There was a lot of tears and frustration just based on the length of time. It wasn't even about the money.
The fund took so long to process the claim that eventually it offered Kathy compensation of just $28.99 to be divided between 3 people.
I felt insulted. I would have preferred just an apology.
Australian Super would not comment on Miss Clark's case, but said in a statement that it has now brought claims processing in-house and has seen a significant reduction in claims processing times.
While Australian Super and Cbus were left out of ASIC's scathing report into the way funds manage death benefit claims, it is taking legal action against these funds over their handling of death benefit and disability claims, and it's flagged it could take more funds to court.
Grieving Australians should not have to suffer stress and in some cases financial hardship because of their failures.
ASIC's report covers 10 funds responsible for about 38% of the APRA-regulated market. It found there was a big difference in claims closed within 90 days between the slowest and fastest funds. Of the claims ASIC reviewed, 78% had delays caused by processing issues within the trustees' control.
We've really worked very hard on improving processes and responding better to what the public rightfully expect of their super fund.
A promise that may be too little too late for people like Kathy.
The Health Minister has ordered an urgent investigation into the staggering premium hikes by some private health funds amid accusations of price gouging. The government has approved annual premium increases of 3.7%, but some gold policy holders have discovered they're facing hikes of 35%. Here's Rachel Clayton again.
Growing up, Judy Giddings loved to play sport, but it came with hurdles.
This is me before my horse riding accident, and probably about the last time I smiled with my mouth open.
Major dental work is only covered under the most comprehensive health insurance policies, meaning Judy has no choice but to pay for top-tier cover, costing nearly $3,000 a year. It's the reason the 73-year-old must keep working.
If I wasn't still working, I would not be able to afford it. But when you're struggling to pay mortgages and food, it means you can't do anything else, literally.
From Tuesday, private health insurance companies will raise premiums across all levels of cover. The government has approved an average hike of 3.7% weighted across all policies. Consumer Group Choice has found among the top 5 insurance companies, basic cover will rise on average by 0.78%, bronze by 2.5%, silver by 3.2%, but premiums for gold policies, the most comprehensive, will spike by nearly 12.6%.
Gold policy holders can be having a 14% increase, and some people can even have no increase or go backwards at all.
The approved increase also does not affect the price of new policies. The loophole has allowed health funds to close and reopen almost identical policies at a higher cost.
I will reserve the right to consider legislative options to outlaw the practice into the future.
Insurer HCF closed its gold policy and reopened it at a 35% higher price in February.
We would hope that the government follows through on legislative changes to ensure that health funds do need to apply for approvals when they're introducing these new policies.
It's just a shell game, smoke and mirrors, and the government needs to say, this is not tolerable. We are going to say if the average premium increase is 3.8%, it is 3.8%.
Health Minister Mark Butler has ordered his department to investigate ongoing phoenixing by health funds and says it's shameful it's continued. HCF says it had to close its former gold policy to improve its financial sustainability, which includes offsetting the decline in the number of young people taking out cover.
That means the overall composition of the policyholders is going to be much older and more expensive to cover for.
It means people like Judy are facing higher premiums. Experts say the system can't go on like this.
We haven't substantially reformed this area since John Howard.
Judy just hopes she can fix her teeth before she has to stop working for good.
I'm redrawing my home loan and using the little bit of healthcare that I've got. And I'm going to get it done, and hopefully then I can lead a healthy life.
Tough choices ahead for many Australians facing unaffordable healthcare.
The Governor of the Reserve Bank has revealed the first meeting of the new Monetary Policy Board did not discuss a cut to the cash rate. The rate's hold comes as national home values continue to rise, putting the dream of home ownership further out of reach for young buyers. Nadia Daly has the story.
Exceptional value on offer. I'm in for 150. Are selling.
With property prices at record highs, it's a tough time to get a foot in the housing market.
I wouldn't want to be trying to buy my first home in this market.
There's a lot of people out there that are having to ask their parents at the bank of mum and dad.
Interest rates are very, very powerful. And so as interest rates come down, it makes an enormous difference to young people.
But those hoping for more rate relief will have to wait a little longer, after the Reserve Bank left the cash rate on hold as expected at 4.1%.
We have made good progress on bringing inflation down and keeping unemployment low. This is a good position for the economy to be in as we approach a period of uncertainty. But we have to be careful not to get ahead of ourselves. Inflation pressures remain and cost of living pressures are still very real for many Australians.
A fact the Treasurer is well aware of as the government fights to avoid being voted out after just one term.
When we came to office, inflation and interest rates were both rising, and now inflation and interest rates are both falling. And this reflects the progress that we've made together.
The economy is still not where it needs to be, in order to bring down interest rates and to raise the standard of living of Australians.
The decision to leave rates where they are comes as Australia awaits news later this week on US President Donald Trump's tariff plan. How's the uncertainty around US tariffs affecting your decisions?
We're not seeing signs that we're being impacted by this. What will be important for us is particularly what happens with our major trading partners and China.
We have such a small direct relationship in terms of trading with the US that the direct impact of the tariffs are not going to, one, hit us too hard, or two, wouldn't be really changing the Reserve Bank's view.
Markets saw next to no chance of a rate move today, but since the decision was announced, the odds of a rate cut next month have fallen from over 80% to just over 70%.
I think the RBA can cut in May after what I think will be a good March quarter consumer price index report, and then again in August after the June quarter CPI, and I think that will confirm underlying inflation, is back in the band.
The rates decision comes as home values hit fresh highs in March, given a confidence boost by February's interest rate cut.
I think what we should be expecting is a really subtle rise in housing values, but a broad-based one.
Property prices climbed 0.4% nationally, with the median home value now over $820,000. Prices rose in all capitals except Hobart, which fell by 0.4%. Sydney was up 0.3% and Melbourne 0.5% in March.
We still have very unaffordable housing prices. Even though sentiment's rising, it's doing so from a low base. And we're also seeing some uncertainty around global trade wars and conflict as well.
CoreLogic's head of research, Tim Lawless, doesn't expect another boom anytime soon.
I think given the rate cutting trajectory is likely to be a fairly drawn out one, we're not really expecting housing prices to respond suddenly very significantly.
One piece of welcome news for those still struggling to break into home ownership.
Congratulations, sold!
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.